Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be sharing the top 10 stocks that I've found to be on sale right now that I believe are strong buys. We all know that growth and tech stocks have been selling off like crazy lately amid the rise in the 10-year bond yields, the 7% inflation reported in December, as well as talks about the banks raising interest rates sooner than later. And this has led to a market rotation from growth and tech stocks to more value stocks such as financials and oil companies. But if you're a long-term investor like myself, any sell-off within your growth stocks should only be a reminder to buy the dip and just become more bullish on those companies long term. And I can almost guarantee that a lot of these short-term market worries will be gone and passed completely over within the next year or two, and a lot of these companies within the list I'm about to share will be worth a lot more in my own opinion. So if you do enjoy, make sure to drop a like on this video to help support my channel and subscribe with bell notifications turned on so you don't miss any of my future uploads. Also, I just wanted to let you know we talk about these stocks in much more detail within my Discord community of investors, where you can also gain access to all my stock trades, my stock intrinsic value calculator, weekly group coaching calls, and much more. So if you want to gain access for only $1 in your first month, make sure to click the link in the description or the pinned comment below to join my community of investors. Anyways, let's jump straight into these top 10 stocks on sale. Starting off with the first stock on sale right now, that would be PayPal with ticker symbol PYPL, or PYPL.NE if you're on the NEO exchange here in Canada. PayPal stock has clearly been a solid performer over the past 5 years, being up 330%, but over the past year, PayPal stock is down 30%, and from its all-time high, down about 40%. And the main reason why PayPal stock is down so much over the past year is because they cut ties with eBay, meaning that the sellers on the eBay platform can no longer use PayPal. As a result, PayPal's total payments volume, or TPV, fell quarter over quarter and saw slower annualized growth due to eBay's TPV dropping 46% year over year, which also led to only 4% EPS growth year over year. However, aside from eBay's impact over the short term, PayPal is still thriving. Excluding the eBay results, we can see TPV grew 31% year over year, while merchant services revenue grew 25% year over year. Also, customer engagement on the PayPal platform is still growing pretty quickly, where the number of payment transactions reached 4.9 billion in the quarter and 44.2 transactions per active account. Not to mention, PayPal is still incredibly profitable and generates tons of free cash flow despite these eBay results. So I believe this dip is presenting a good buying opportunity for the long term as the online payment space continues to grow in popularity. Alright, now the second stock on sale right now is one of my highest conviction companies, and that is Trulieve, with ticker symbol TCNNF on the US OTC exchange, or TRUL.CN on the Canadian Securities Exchange. As we can see, Trulieve stock has nearly doubled since going public in 2018, being up 84%, but over the past year, Trulieve is down 50%, and from its all-time high down about 55%. But despite this massive correction in the stock, as well as the entire US cannabis sector for that matter, Trulieve's fundamentals and future outlook have never been better. In the last quarter, Trulieve saw revenue growth of 64% year over year to $224.1 million, and if we annualize this, it gives us about $1 billion in revenue before the Harvest merger took place. And at a $4 billion market cap, this makes Trulieve trading at a forward price to sales of only 4, having a gross profit margin of 69% and an EBITDA margin of 44%, which is quite ridiculously cheap in my opinion. Keep in mind that Trulieve is also very profitable, so their forward PE is below 20 right now, and for the amount of growth they're seeing, I think this is ridiculously cheap. And when we take into account the additional revenue from the Harvest stores, this will make a huge impact on Q4's revenue, so I am very excited to see these results coming in the next year. Also, take it as you will, but analysts have an average price target of $65 for Trulieve shares, representing close to 200% upside over the next 12 months, and there isn't a single neutral or sell rating on the stock. Overall, I'm super bullish on Trulieve over the long term, and I think the stock is incredibly undervalued right now, but the short term might still be choppy because this is a company that's still in a highly regulated industry. Alright, moving along, the third stock on sale right now is of course Google, with ticker symbol Goog or Goog.NE on the Canadian NEO exchange. Looking back, Google stock has done incredibly well over the past 5 years, being up over 220%, and over the past year, Goog is still up about 40%, but has recently been trading down from its all-time high by about 11%. And to be honest, the only reason why Google is trading down from its all-time high right now, in my opinion, is because other tech stocks are too. Nothing has changed fundamentally about Google. They have done incredibly well over the past year. In the last quarter, we can see Google's revenues grew 41% year over year, while their EPS grew at an astonishing 71% year over year as their ad business boomed. And when we look at Google's valuation, it's only trading for a trailing PE ratio of 25.7 right now, not even excluding their huge pile of net cash that they have on the balance sheet right now being over 115 billion. So in effect, if we back out their net cash of 115 billion, Google's trailing PE comes to only 24.2, which I feel is incredibly cheap. Also in Q3, Google already produced more EPS than is expected in Q4, which is always the best quarter of the year for advertising companies, in terms of revenue at least, so I think Google should be able to beat on EPS quite easily if I had to take a guess. Overall, I just love how Google basically has a monopoly in the online search space, but they also own YouTube, so I'll be a buyer at these prices guaranteed. And speaking of online advertising, the fourth stock on the list today is Meta Platforms with ticker symbol FB or MVRS.NE if you're on the NEO exchange in Canada. Meta stock, formerly known as Facebook, has done quite well over the past 5 years, being up about 140%. And over the past year, Meta is still up about 16%, but recently it's been trading down from its all-time high by about 17%. Right now, I personally think that Meta is showing some incredible value based on their strong fundamentals as well as the huge opportunity with the metaverse in the future. Starting with their financials, just look at Meta's solid history of revenue and EPS growth. It honestly doesn't get better than this. And based on the trailing 12 months, Meta is trading for only 23 times trailing earnings and a PEG ratio below 1, showing that the stock could be quite undervalued right now. Next up, the balance sheet is stellar, where Meta has 58.3 billion in cash and cash equivalents, while they also have total current liabilities of 17.8 billion and total long-term debt of 12.1 billion, which could both easily be paid off. As for their future opportunity, the metaverse is going to be huge, and Meta has a huge lead in terms of VR and AR technology with their Oculus products that sold like hotcakes on Christmas. So overall, Meta isn't my biggest position for no reason at all. I absolutely love this business, and I think that it's undervalued right now, so I will continue buying when I can. All right, now the fifth stock on sale right now is Amazon with ticker symbol AMZN or AMZN.NE on the Canadian NEO exchange. Amazon stock has been an absolute beast over the past 5 years, being up over 260%. But over the past year, Amazon is down about 8%, while it's also down about 18% from its all-time high in 2021. Now, in the past, we've seen Amazon stock shoot to the moon, while other times it trades flat for a year or longer, and the latter is what we've seen throughout 2021. That's because Amazon has struggled with the supply chain this past year, among other issues, and they've been reinvesting heavily into their fulfillment network, so this is a period of lower profits and heavy investment for Amazon. But I believe on any good news, especially if they come out with a solid earnings report in these upcoming weeks, Amazon stock could trade a lot higher than where it is at about $3,000 per share right now. That's because Amazon is trading for the cheapest it has ever been in terms of PEs, while analysts are expecting 36% growth each year for the next 5 years, so that is still really solid growth. Not to mention, analysts have a price target of $4,100 per share, which represents 35% upside from current levels. So I, for one, will be a buyer of Amazon stock on any dip, since I believe we're only at the beginning of adoption of e-commerce and cloud computing worldwide. All right, now stock number 6 on sale right now is another e-commerce play, and that is Shopify with ticker symbol SHOP or shop.to on the TSX in Canada. And if you thought Amazon stock was a beast, check this out. Shopify is up nearly 1,800% over the past 5 years, but more recently it's down 15% over the past year and down 40% from its all-time high. And despite the valuation still being extremely elevated on a fundamental basis, I still believe this is a great buying opportunity for the next 5 to 10 years, and here's why. Firstly, Shopify just reported record Black Friday and Cyber Monday sales for 2021. Shopify announced sales of $6.3 billion globally, being a 23% increase from more than $5.1 billion reported for Shopify's 2020 Black Friday Cyber Monday weekend, and more than double their merchant sales from the same holiday shopping weekend in 2019. Not only this, but Shopify just announced a partnership with JD.com to expand their e-commerce presence in China to over 550 million new customers, which I think is huge news. Finally, Shopify is in the number 2 spot, only behind Amazon when it comes to e-commerce, and I can see them becoming a $1 trillion business by 2030. So despite the valuation, I'm taking advantage of this buying opportunity because I believe Shopify is an excellent excellent business that has tons of growth to go in the future and could one day be a $1 trillion business. The 7th stock on sale right now is Tesla with ticker symbol TSLA or TSLA.NE on the NEO exchange in Canada. Over the past 5 years, Tesla stock is up the most in this list by 1,870%. And even over the past year, it's still up 18%, but more recently it's fallen from all-time highs by about 19%. And I just want to point out how well Tesla stock has actually been holding up lately. Even with a trailing PE ratio of 330 and a forward PE of 122, how can the stock only be down 19% in today's tech sell-off? Well, I'll tell you why. It's because Tesla absolutely smashed their delivery estimates for Q4, and then they have earnings coming out on Wednesday, January 26th, which are expected to be stellar. Ever since the delivery announcement, analysts have been raising their revenue and EPS estimates as well as price targets for Tesla stock, and this should only continue after their earnings report and throughout 2022. Furthermore, 2022 is going to be a massive year of expansion for Tesla, where they have 2 brand new gigafactories coming online, one in Austin, Texas, and the other in Berlin, Germany. In fact, just this week, Tesla Model Ys were spotted outside the Austin gigafactory, highlighting that the company is already beginning to produce vehicles and are likely ready for regulators to give them the go-ahead to start ramping production very soon. I personally think Tesla stock is undervalued right now at a $1 trillion market cap, and that could also be the reason why it's been holding up so well during this tech sell-off. And as such, I have a price target of $1,500 per share by the end of year 2022, so I'm going to be buying a lot of Tesla if it continues dropping. All right, now the 8th stock on sale right now is Disney with ticker symbol DIZ or DIZ.NE on the Canadian NEO exchange. Disney stock is up only 35% in the past 5 years, while the stock has tumbled nearly 14% over the past year and nearly 27% down from its all-time high back in March of 2021. So Disney really hasn't had the best performance out of these 10 stocks by any means, but I do believe that Disney is a solid staple to anyone's stock portfolio just because of how well diversified and innovative the company really is. And my biggest bullish point for Disney right now is their growing streaming service, Disney Plus. They launched Disney Plus pretty much at the perfect time back in November 2019, and over the 2 years since, the platform has now gained 118.1 million paid subscribers. But their growth has slowed down tremendously, where they only gained 2 million new subscribers in the last quarter, which is a big reason why the stock is down so much. However, with that being said, I do think that Disney is a buying opportunity on any dip if you're holding for the next 5 to 10 years, since they are the leaders of the content industry. We can also see that their forward PE is close to 30, while their PEG ratio is only 1.1, being quite attractive right now. Overall, Disney might continue seeing some short-term trouble when it comes to their subscriber growth on Disney Plus, but I do think that they will recover within the next few years and they should do very well over time. All right, now the 9th stock on sale right now is Visa with ticker symbol V or Visa.NE on the Canadian NEO exchange. As we can see, Visa stock has done very well over the past 5 years, being up 155%, but it's barely up by 5% over the past year, and it's actually down about 15% from its all-time high back in August of 2021. However, in the latest quarter, Visa's EPS jumped higher than previous 2019 levels and is expected to continue growing at 20% throughout 2022, so this is where I see the opportunity when it comes to Visa stock. Another reason Visa stock is a great buy right now is because they are a hedge against inflation. With the increased money supply throughout the world, Visa will benefit since they earn a fixed percentage off each transaction processed by their network. So despite the high 7% inflation we saw in December, Visa should remain strong, and earnings should rise well above inflation levels. Finally, I also love Visa because they still act as a duopoly with MasterCard in the payment space, despite all of this new competition coming into play. Everyone still loves spending on their credit cards to earn rewards, myself included, so I can't see a huge shift from Visa cards coming anytime soon. Anyways, that's why I love Visa, and I will continue buying on any dips. Alright, now the 10th and final stock on sale right now is Netflix with ticker symbol NFLX or NFLX.NE on the Canadian NEO exchange. Now I wasn't actually going to include this one in my video here today, but one of my Discord community members, Jay, actually let me know that Netflix plunged after their Q4 earnings on Thursday, and it could be a good buy. On that note, if you'd like to join my Discord community of investors, there is a link in the description or pinned comment below. Anyways, Netflix stock fell 20% after hours to about $410 per share since they expect slower future subscriber growth, but they still beat on EPS while revenue was in line with analyst estimates. We can see Netflix added over 8 million subscribers in Q4 while they're only expecting to add 2.5 million next quarter compared to 4 million in the same quarter a year ago. Now of course this is disappointing, but does it really merit a 20% sell-off in the company's value? I personally don't think so. Netflix subscriptions are very seasonal and content dependent, so whenever they have better shows like Squid Game that came on, they're going to see a huge boost in subscribers. And just look at their history of revenue growth. It's honestly one of the cleanest I've seen in the tech sector, since it is a subscription-based business model and very predictable over time. And clearly the stock price has reflected this growth over the past 5 years, with Netflix still up nearly 200% even after the recent 20% dip. Overall, I do believe Netflix is the content king when it comes to streaming, and it should stay that way for the foreseeable future, so I do think that this is a buying opportunity for the long run. Well anyways, those are my 10 stocks that I think are on sale right now and could be presenting some really good value. I honestly will be buying the dips on a lot of these stocks, but yeah, just let me know down below what you think of them. And if there are any other stocks that you would have added to this list or even replaced from my list, definitely let me know in the comments down below. I would love to hear your opinions. But yeah, don't forget to drop a like for me on this video because it did take a lot of effort. And then if you haven't already, please consider subscribing so you don't miss any of my future uploads. And with that said, I will see you all in the next one.